in terms of what's gone on, the trade is gold. And the collapsing debt market is not signs of dollar strength. Just because your interest rates are higher, you were strong. And now you've actually had that invert in an extreme moment. So it's I'm concerned for people that are under the influence of the dollar pan-Americano maximalists. You have Bitcoin maximalists, you have maximalists of forever America empire and the dollar and the debt market. And gold is saying, no, mate. He's standing very quietly in the corner of the bar, shaking his head and getting more and more rich, getting bigger and higher value.
The US dollar has recently experienced sharp declines, with the dollar index falling below 98. Its lowest level since March 2022, driven by mounting trade tensions and growing fears of stagflation. At the same time, U.S. Treasury yields have surged, with the 10-year yield reaching 4.42%, signaling a broad sell-off in bonds. Japan, currently the largest foreign holder of U.S. Treasuries with over $1.13 trillion, has hinted at using its holdings as leverage in trade negotiations with Washington. Meanwhile, China has been warned against retaliating to new U.S. tariffs by offloading its U.S. bond reserves, as such a move could trigger instability in global financial markets. President Trump's recent tariff announcements have added to market volatility. Although the S&P 500 surged 8.65% over just 8 days, analysts raise concerns about long-term repercussions, drawing comparisons to the uncertainty surrounding Brexit. Additionally, America's fiscal vulnerabilities are becoming more pronounced, with the national debt-to-GDP ratio now at 123%, a reflection of prolonged deficit spending and expansive stimulus efforts in response to crises like the COVID-19 pandemic. Market sniper Francis Hunt argues that today's real opportunity isn't in the US dollar or Treasury markets, but in gold and the unraveling debt system. He believes that gold is quietly but powerfully signaling a rejection of the dollar-centric financial order, even as mainstream narratives uphold confidence in U.S. assets. According to Hunt, gold's steady and understated rise reflects a growing awareness of the inherent weakness of fiat currencies and the unsustainable foundation of a debt-driven global economy. We're about to explore the video, but first, subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
One, the big event since we last spoke was dollar down, debt down, when Trump was rattling the cages on tariffs, which was an instant back down, led to an instant back down, and also led to him posting on his Truth Social, I wasn't afraid about the bond market, which tells me he was afraid. He got told to be afraid about the bond market. He probably doesn't understand enough to know, but he probably had a handler tell him. So it's the usual inversion, perversion. And actually, China hasn't sold us a meaningful amount. Japan hasn't. UK's been an accumulator, and so is the Cayman Islands. So it's actually on quite small sales, and you actually had the rates on the 10-year. So I'm saying we predicted that, by the way, when Liz Truss were thrown under the bus. That happened in the UK. Both the pension markets bonds went down and the pound went down, even though they pumped the rates up, and they threw out Truss, who was doing a stimulus budget, which was going to lead to more debt, but pass tax cuts and try to get everybody engaged in economic activity and maximizing earnings again. That's generally not a bad budget to do, but she got thrown under the bus for the fact that Britain just doesn't have the bandwidth to do that amount of extra debt anymore. And I was saying it's a microcosm of what's coming for America. That was September 22, and literally last month, in the last 4 weeks, we had a major back down after the rate spiked and the dollar went down. In fact, the dollar's at recent regional lows on the dollar index against the euro. The euro is actually high, and that's a cranky strength from the euro. It's because anti-dollar, the dollar bad. It's not because the euro good. Remember, they're all parachutists falling out of a plane. They have their moments where the one is falling a little bit less fast than the other. And the aeroplane is gold. The other things that really get me is he said there was a shortage of treasuries, which is probably the most absurd thing that can be stated. And the rationale he gives is, at our current interest rates, which would be today, for example, 4%, because the interest rates are lower, the relationship of the seesaw, than they were back then. The only difference is if you're taking 2000s, gold was $252. How can you say bonds are more valuable today? Because the interest rate is marginally lower. The whole currency, since CV19, everyone's cost of living has gone up 20%. There's people with charts for this. Everything costs 20% more. Why? Because the proliferation of debt, the 7 trillion, that led to the money being issued, has led to everything needing to cost 20% more because the buying power of the money is 20% less. You actually issued in that short duration of 18 months, 25%. So the first leg is an immediate 20%, everything costs more. How is this even a thing? So how can you look at the interest rates that this person with a whiteboard does and say, boom, there you are. We're at a slightly lower rate than we were 20 years. This proves there's a market for T-bills because they're worth more today. But they valued in dollars. And gold was 250 then, and today it's 3,300. How do you not see that post-CV19, the 40-year bull market has turned, and even before that, we've been in a devaluation of both debt and money. And that CV19 in one lockstep delivered 20% devaluation. Cost of living falls by 20%. If you didn't go up in income by 20% in that one proliferation event, if you have people that'll tell you that there's a shortage of treasuries and try and make a case for it and say that they are more valuable today than they were 20 years ago, when the gold price has done what it's done. What do you say to, that's my big frustrations. Then there's a melt-up crew. You asked me, what's the 3 things? Okay, I've named 2. The third one, and then I'll finish and answer your question. And I'm doing a thread on Twitter right now about this, is the melt-up to new highs brigade. Right now, you should all BTFD the stock market for the melt-up to the new highs. Now, there's a plethora of names. Not 1, not 2, not 3, that are all in the melt-up camp. In actual fact, my view is the minority view. Any dip is a buy the dip. We're talking stocks specifically here, but this is a BTFD moment for most of them, and that you'll run to a new high on the stock market. Now, don't get me wrong. Eventually, stock markets go higher, generally, on account in the long term, because money is being devalued. We get that. But the notion that we are through with events right now and that there isn't the possibility of a rally and a further sell-off to come. Here's what's happening in the world.
According to the World Gold Council, China increased its gold reserves for the 17th consecutive month in April 2024, underscoring the metal's central role in the broader de-dollarization movement. This sustained institutional demand has provided a strong foundation for gold prices, even during temporary pullbacks. Meanwhile, a weaker US dollar, driven by expectations of monetary easing, has further boosted gold's global appeal. Despite this support, gold has recently pulled back from its highs and is on track for a second consecutive week of losses, hovering around $3,230 per ounce. Is this a sign that the worst may be behind us on the tariff? Drop your comments below and let us know what you think. If you found this video helpful, please like it and subscribe for more.